And I ain't no time to air. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew, navigating through the markets, knowing what to do. Federal Reserves in control, making moves, keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Welcome back, everyone, to the official FOMC stream. That is right. We created it, we invented it, and you love it. I love it. Everybody loves it. I know you have your options and who you watch and who you watch with, and I appreciate you taking the time and being with the fam here today. A lot of these FOMCs have been pretty boring, nothing burgers, and guys, the odds of that happening again are always good. But we watch together, we try to make it a little bit more interesting, a little bit more entertaining, and we do a pretty good job most of the time. So without further ado, let's just jump into my little intro here. It is currently 1:32 p.m. 1:31 at 2 p.m. East. Ooh, Bitcoin's dumping. At 2 p.m. East, the interest rate decision will be published to news outlets, and we will, as a group, together Google it and try to find that interest rate decision as soon as possible. At 2:30, Chairman Powell himself will join us, and he will speak, and he will give his speech that is always so unique and different every single time. And in that speech, we'll be looking for a few important things, key potential notes. We'll get into that in just a little bit. We look for some certain things, and we'll do that together as well. In the meantime, I ask, could you smash the like button, subscribe, share out the stream, hype it up, put something in the chat. Let me get a chirpow in the chat, perhaps. Maybe a little chirpow. Warm it up. It's going to be a good time. We have a good amount. We got a good buffer, actually, until the interest rate decision comes in. So, of course, the most important thing today is going to be what color Jerome Powell's tie is. Every single time, that's the biggest, most important thing. No, I'm just kidding. Let's kick it off here. So, people have been speculating virtually every single month that we would get an interest rate cut. Last year, I believe we were slated for 5 cuts this year. That was knocked down, I believe, to 3, and then maybe knocked down again to 2. At this point, it doesn't really matter. What does matter is that we are going to, with almost 100% certainty, see an interest rate cut this year. That may come later in September, perhaps Q4. We don't know. Though the rumors fly every month that it's going to happen this month, that is probably not going to happen, in my opinion. We have gotten wild curveballs before, but man, I'm not so sure about this month. What do you guys think? You're welcome to disagree. Be optimistic. When we look at the Fed rate calculator or probability guesser, we'll call it a probability guesser because, what else is it? We see some actually pretty interesting stuff here. We see, for the first time at any of these meetings, actually, a 3.5% chance of a hike coming in today. Not what anyone's looking for, not what anyone wants, but we have been talking about how a hike might be more probable than a cut at this point, and the calculator actually agreeing, finally. From yesterday, and this is actually just from today. Wow, that's interesting. I didn't even catch that. Yesterday, there was a 0% chance, basically, now up to 3.5 today as we get into this meeting. Yesterday, we had a almost 2% chance of cut, 25 BPS, down to 0 today. This probability calculator not super bullish on a cut today. That's weird. It says 2 hours and 25 minutes. I wonder if that just needs to be updated. Because, yes, 23 minutes. Well, scratch that, because apparently this is changing by the second. That hike now gone, even though it was just there 2 hours ago, and now a 0.1% chance of a 25 BPS cut, and a 99.9% chance of nothing happening when it comes to the interest rate. That is okay. And that is largely what markets, I believe, are pricing in. I don't think that that's a surprise to anybody. But you can see that even just 2 hours ago, there was a non-zero chance of a hike. Now here we are. That's gone away. This is it's volatile. At worst, it's volatile. And that is true of the market as well. I have Bitcoin up here, and we have our start of the stream. We can get rid of that now. Our interest rate decision, and of course, Chair Powell when he speaks. And we have what I like to call the FOMC blueprint here for trading. Now, I always recommend you guys just take your hands off the mouse. That's why we stream this. We make it a little more interesting. Maybe keep your minds busy. I always recommend not to trade these. These can be extremely volatile events. And even if you choose the right side of the trade, whether it's long or short, even if you're right, you tend to get stopped out or even liquidated during these events because we see something that I call the FOMC trading blueprint. And essentially what that is whatever direction the market seems to be trending into the decision. So let's go ahead and say that's a downward trend. We'll say a downward trend for this one. All right, this hits like 99% of the time. It's wild. Let's say a downward trend. As soon as that interest rate comes in, and even if it's what we expect, we tend to see that direction reverse. So we'll say up. From downtrend to an uptrend. And then once again, when Chair Powell speaks, we see a reversal one more time, and that tends to bring us roughly back to where we started. So like I said, long, short, it doesn't really seem to matter. You tend to just get stopped out or liquidated in either direction because the market reverses usually about twice. We'll see how this ages today, but be very, very careful trading today, especially with leverage. We do have exchange partners in the video description below. If you are going to trade, use my link, sign up using my links. I guess that way if you get wrecked, at least a little bit of that comes and supports the channel. I don't know. Just be safe, guys, today. Please don't trade. Don't take on risk. Just sit back and relax. Enjoy the show. Let me see. What do we got next? So his speech at 2:30. What are we going to be looking for? We're going to be looking for likely 2 or 3 things here. The first, obviously, being any interest rate decision cut, or that's not going to happen. But anything related to that, we will listen to his intro speech, which is, you guys often think of it as like robotic, and it is, but it's not actually robotic. What it is, it's very specific. Each word choice is very specific. And if we go from one meeting to the next with absolutely no change when it comes to the Fed and what they're seeing, you will hear the exact same speech word for word. So what's important and what you can kind of read into here is any word choice that has changed from the last speech. And that does end up making it almost exactly the same as the one before, but a little explanation for you, a little explainer as to why it always sounds so kind of AI written or something is because if there are any choices or any word choices different than last month, it is intentional and it is signaling something, whether it's large or small. It's up to you. It's up to you to interpret, but even down to just singular word choice can be potentially important. Next, we are likely going to get a dot plot update. The dot plot is essentially the voting members of the FOMC projecting out into this year, next year, the year beyond, and where they see interest rates being at those times. And so I should probably have it pulled up, but what we're likely to see is members either change their mind, become more dovish or more hawkish, and the updates to that dot plot can be important and have consequences for the mid and long-term future of what the Fed does. In addition, let me see what else we got here. We can have any kind of talk about quantitative easing or quantitative tightening, basically imagining money into existence or unimagining money into existence. This is the hot topic that we've had over the last few months, as the Fed has signaled and said that they are likely to end quantitative tightening, removing money basically from the money supply. What was it? mid of this year? Well, guys, we're at mid of this year. We are officially in June. This is exactly halfway through the year. Well, it doesn't guarantee that we get that today, the end of quantitative tightening. We are likely to hear some kind of update or forecast as to how the Fed sees that unfolding over this year. The biggest thing, actually, going back to that dot plot real quick, is we may see a revision from the 2 forecasted cuts down to 1. This is what a lot of people are speculating for today. I'm not sure I'm on track there, because what we have seen since the last meeting in May was basically mixed economic indicators. I believe GDP contracted by 0.3% in Q1, driven by import spikes ahead of tariffs. Wouldn't that have expanded it? Maybe I got that note wrong. Either way, while April jobs reported that we had added 177,000 jobs, keeping unemployment at about 4.2%. CPI? No, leading economic index fell by 1% in April, signaling potential slowdown and uncertainty. This is really what it comes down to. We can look at numbers. We can say we've had CPI prints, CPE prints that are lower or cooling inflation, and we have, but it almost isn't about that right now today. Lots of people, and we'll get to the little feud going on here in just a minute, think that the Fed maybe is playing favorites or being biased towards the current U.S. regime or not. And I'm still of the opinion, even though the Fed is great to cover, but we're not really fans of the Fed here when it comes to Bitcoin. We're fans of them printing. I still, after watching them for years, don't really believe that to be true. I think that they have a path and data that they follow, and just because they see a little cooling, which is good and gets them closer to cutting, that doesn't necessarily mean that it is immediately time to cut. They have to consider the bond market, and what they really have to consider is the uncertainty that has been cast on this year, which the impacts we may not have seen in any of the data we've had reflected so far. It may take into Q3 or into Q4, into Q3, Q4, Q3 next quarter. It may take into quarter 3 or quarter 4 of this year to really see what these big changes have done when it comes to the cost of goods and services and the employment in the U.S. So now the favorite topic. President Trump today, or I think it was today, had some words for Powell. He had some words. Let's take a look at these words. Let's take a look.
Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower. It'd be nice to be 2.5 points lower. We'd be saving $800 billion, $700 billion. That's a lot of money, right? Take it for nothing, for absolutely nothing. Am I allowed to appoint myself at the Fed? I do a much better job than these people.
I'm not sure if he's allowed to appoint himself. But it is no surprise that Trump is not a fan of Chair Powell right now. He has had some very choice words for him over the last, let's be real, the whole month, right? The entire month. There's been some definite political pressure. And actually that clip was a little bit late. Right before that, I believe, is when he called Chair Powell stupid. I think he like literally called him stupid in that. And that really just highlights the political pressure that is on the Fed. Now, I believe that the Fed is likely to prioritize the data. I don't think that they're, as human as we can be, I don't think that he's going to be like, oh, he called me stupid. Now we're not going to, now we're going to change our fiscal policy. Remember, guys, Powell is the chair of the Fed, but he is only one of the voting members of the Fed. There's 12 members plus the chair, I believe. His opinion probably carries more weight than any other given vote in the board. But by no means does his vote determine what happens. And that's literally what we see on the dot plot, right? We see all the different members and their opinions and what they see the interest rate being over whatever amounts of time. Him specifically doesn't have the power to instantly change things in this way. It is the voting board. I believe J.D. Vance commenting, kind of putting more political pressure on the Fed as well here today. I don't have the statement from him. But overall, I think that markets are cautiously optimistic. We see the S&P is close to all-time highs, hanging out here. We see Bitcoin at 104,000, maybe not doing the best right here at this moment, but hanging out near all-time highs. Really the weakest card in this deck right now is that US dollar. US dollar is very much down. Actually, even in just the recent days, breaking multi-year horizontal supports, multi-year levels, trading as low as 97.6. The dollar falling, maybe can be an explanation for some of the strength that we've seen in equities and assets and indices, whatever. Could be an explanation for some of it, but man, markets in general, I think, are cautiously optimistic, and cautiously optimistic, and I think are anticipating nothing happening today when it comes to the rate decision. Forward guidance is always a tool employed by the Fed, and so listening in today and the questions after Chair Powell's speech likely to give us some context or some further kind of hints as to what the future into this year may have. Oh, I almost forgot. I didn't prepare anything on this, but I almost forgot. I just remember this. That in between the last meeting and this meeting was all of the kind of replacing Powell, maybe nominating Besant. Was that actual nomination? Either way, I think it has to get through Congress. But talking about like a shadow chair and things like that. Interesting to see if anyone asks Powell about that today. That was important. I probably should have done something about it, but oh well. Let me see here. Yeah. We're not going to play the previous 15 minutes, although that was pretty sneaky of us last time. The last one, because that gave us some context. That was actually a good segment. Maybe we should have. Oh well. I'm sick of hearing myself talk. Let's maybe a little tunes. Maybe we can look at a little chart for here just for a minute. We got 10 minutes until the interest rate decision is in. That's pretty good timing. 2 o'clock. Yeah. Let's fire them off. We got a good amount of viewers. Hello. I'm going to turn on some tunes just for the next 10 minutes. Really quiet. Let me know. Also, let me know, how has my audio been? We had some issues in the last stream. Are we having issues this stream, or is everything good? Just real low-key vibing little house. Let's go, big cut energy. I like that. Audio's good. Cool. Love the Fed streams. Love you, puppy. Good to see you. What's up, boys? We're here for you. I'm here for you guys. Mr. Poppy in the house. There we go. It is the 10-minute warning for the interest rate decision coming in. Loud and clear. Loud. Powell-tastic. Can I get a chirpow? A Chairman Powell. Guys, love him or hate him. I know a lot of you guys hate him. That's fine. Love him or hate him. The odds of him being the Fed chair come May of next year are very low. Post May of next year, very low. I'm gonna miss him. I'm gonna miss saying Chair Powell. I'm gonna miss covering him. I can only ask Trump, whoever you do put into the position, please make them interesting. I have almost no doubt of that. I don't know. People hate him. People hate him right now because him and Trump thing. That's honestly what I think it is. Crackling the odd time, yeah. Let me see. Well, the crackling should be gone now, but now you might hear other sounds. It's kind of give and take. Get the crackling, or you get, I don't know, any other sound in here. The song. Friggin' ads. Are the ads playing? Bear. Keep it clean, keep it clean. Who is all here today? Let me see. Ace of Hearts is here. You're here every day, bro. Adam Buzzard, Book of Mark, what's up? Brandon Keys, Brian Stewart, Bite Bandit, CKCF, Chasing Candles, Chemo and Crypto, Crypt Anon, Crypto Weirdo, what's up, bro? Crypt Arrow, Crypt Chef, Dank Enan, Darren, David Brum, how are you? Dylan VA, Erdan, Fella7, what's up, Dude TBG, Foxy Thorny. Cheers, my friend. You're always here. Love you. Gary C, Hank, Herein, 100 Air, I am Jess, it's Autopilot, James Quick, Johan Mobile, John Doe, Johnny Bravo, hey Johnny Bravo, Jonathan Carter, Josh Kennington, JTM, Just Play, Kenneth Shakon. What's up, Chris Pax, my friend? Good to see you. Long Mountain, Marco Junquiera, Matthew Schmeedy, Mr. Poppy, Nebulous Nub, OBSY. Dude, we have like thousands of people here. Let's go. Let's go. Monkey Wars. The names are pouring in. Say hello. What's up, Ski Mask? I see you subscribed. Prod Betwixt. Oh my god, there's so many names. Rave Song Records, Rain. Puppies on Crack, great name. Raw Flat Meat Earth, I like that. Rob Nelson, Romanian Pipple, RPM, R.S. Schwartz, R.S. Kanor, how are you, man? R.S. Miller, Rudy LaPlane, Rudy Poo, Rusty Dagger, Safrenic, Santiago. What's up, Ryan Birchfield Music, how are you? Secker1Z, Silas, Sergio, Shu Reek, Smash Toshi, Super Pro Max Plus. What's up, Sin? TBJ, 10 Pence, Pickle, T.I., Tillin, Timothy Christopher, Tom Salisbury, Tony Urban, Tor, Toxie 𝐂𝐴𝐳, Trinity AQK, Ultra CDP, Vapo Chilled, what's up, friend? Still vape free, baby. 6. I'm on 8 months. I'm going to come up on a year here soon. No vape. Let's go. Smash the like button for no vape for 8 months now. Let's go, boys. Waffle Cones, VZ Fat Cat Volks, Verhoofde Flufen, Unquickerless. Man, some of your names are hard to pronounce. Waffle Cones, Wayne, Wojak, Yellow Spine, Zesty Snipes. What's up, 007 Jupy, Aki Drawl, Arnold, Abagiani, Aviation, Baruch, Benyam, Batcat, Best of Cars, Bajorn. Dude, we have so many people here. I could just keep doing this all day and there'll just be like more names. Boston Drain, Brian Stewart, Buddy Cherix, Bite Bandit, CJ, CK, Casual FPS, Cherry City Bullies is here, Coors Light here, Crypto Surge is back, Crypto Dave, Crypto Mania, Crypto Murph, Crypto Steve O. What's up, brother? What up, what up, what up? Dan L, Dan Pascaru. Who did I miss? Egg Sheeran. Who did I miss? Florida Man Investing. They are Folsom Hodel. I see you. Gowd. Gomer Pyle. Henk. Herein. Hold up. If it's not psychosis, if it's a religious experience. You guys have like full sentences as your names. You're making this hard on me. James Quick. Janix. Jasper. Jasper F. Jeremy Schaffner. Jarian Jeff Pickett. Dude, I think I could just loop this forever. It'd be like hours long of a stream of me just doing this. Let's go. If you're here today and you're having a good time, let me know. Hit that like button. You hate his guts. Hit that like button. FOMC Lo-Fi, brought to you by DJ Crown. In the house. Smoked a bunch of glue for this meeting. Don't smoke glue, Crypto Nate. That's not good for you, man. Getting a deep tissue massage. Let's do it. Let's do it, man. I called you twice, Herein. Well, yeah, because it cancels it out. I understand. What's up, Martinas? How are you? Do I use Pionex? No, I do not. Nah. No. Not a very liquid exchange from my experience. What's up, Julian? Smokesar. Tom Powell. I did quit vaping, Brian. That's why I said I've been 8 months. 8 months, no vape. That's why I said smash the like button. 8 months. Not a single nicotine of any kind in 8 months. Huge. Gina Simps. We are Gina Simps. We are. That I will admit. I simp for Gina and only Gina. Oh, Gina. Wouldn't it be amazing? I'm putting Gina's in chat. Wouldn't it be amazing if she just like showed up for an FOMC randomly? Wouldn't that be just bonkers? Just in the crowd. Just like, I missed you, Tom Crown. I could never leave you. I'm going to see if I can gift out memberships really quick here on my phone. Well, let me do it on the PC. But if I open the stream to 4,000 people watching, let's go. Let's get 4,000 likes. Can I do it on my phone? Probably not. No. I can't even gift memberships. What's with that? Why does YouTube do this? YouTube, why do you do this? If I turn my phone sideways? I don't understand, dude. I only have super chat, super stickers, and free member milestone chat. Whatever. It is what it is. It is what it is. Huh. All right. Maybe moving up in interest rate decision. Maybe we did it. Maybe we did it wrong. Maybe it's like this. We'll see. I'm going to leave it the way it was. Dollar moving up into this decision, now coming back down. We're on the 1 minute, so don't get too excited. Bitcoin just largely in this falling channel for right now. Not a lot of change. When your egg don't work like they used to, I don't know what the... I think I don't get that reference, Egg Sheeran. I'm sure others do, though. I'm sure others appreciate it. A man can dream that Gina will show up at some point. A man can dream. Let's see. 3 minutes for this decision. I'm going to open up. There we go. Crypto Steve O gifted the memberships. I literally, like, look. I don't get it. I don't understand. Like, 50% of the time it's there for me. 50% it's not. What's your vote for the poll? My vote's right up here. I agree with almost 70% of you. 1,500 voters. We should have more than that. Let's get that to more than. Let's get to more than that before it starts. Let's get that up to the thousands. I mean, if I tell you my opinion influences what happens in the poll, it's cheating. It's cheating. How's the Honda? Doing good. The CR-V is doing real good. Doing extra good. I really like this car. Really, really like the CR-V. I'm going to pull up cryptocraft.com. If you guys don't know what it is, just give them a free little shill here. Cryptocraft.com. I think they might have like some ads. I don't know. There's not like premium or anything. You don't have to pay for anything. Very similar to investing.com, except it's tailored for crypto. 2 minutes, 25 seconds. I'm going to use this. Open up your tabs, guys. Open up your various tabs and things. Your search engines. And prepare to put the interest rate decision in the chat. Do it as quick as we can. Let's get it here first. Please put the source. Please don't just say no cut, no source. Remember, any source published right now can't know. We won't know until after 2 p.m. 470 likes is too low. That is disrespectful. I agree. Stop riding the coattails of others. It costs you nothing. 1,400 people, 1,600 people now voted in the poll. That means 1,200 of you just could have hit the like button and you didn't. It's okay. You still have time. I won't hold it against you. Tell a good joke? I don't know, man. Jokes on the spot? What do you think I am? Search engine rev and I'm ready. We got a minute. 100 BPS is married with crypto. I don't know about that. TradingView says that it is now 2 o'clock. Dude, all of my clocks are different. Well, maybe it's 2 o'clock right now. I'm seeing a no interest change. No change. The dollar getting spicy here. The dollar dumping on the no cut. Whoo. Look at that big red candle for the dollar. Bitcoin responding a little bit to the upside, but whoo. The dollar erasing almost all of its gains for today. Actually, it might have literally erased all the gains for today. Or it didn't have any. The dollar now dumping on the expected no change here. Bitcoin up a little bit. This isn't the biggest moves we've seen, though. We've seen some very big ones. Very big, but I'm liking what we're seeing so far. Let's check in here, because now we have another 20-something minutes until Chairman Powell speaks. Let's check in on stocks. Stocks reacting almost identical to Bitcoin. Little pop, 0.13% in the minute. Let's pull up gold as well. What's gold got going on down here? Boop, 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 boop. Gold, similar to Bitcoin and stocks. Interesting. I feel like it's been a while since we have seen gold and stocks and Bitcoin move opposite to the dollar on one of these interest rate decisions. Who put it in first? Forex Factory. I see you, Rave Song Records. 50 BPS. I don't know, man. No change. Who could have predicted? Certainly not us. Unchanged. Yeah, VC Fat Cat, don't joke about killing people, please, brother. Even if they're people you disagree with, please don't joke about killing people. What's their incentive to lower? You're just here for the tunes. All right. Forex Factory. Thank you, guys. You did great. You did great. Great job. Putting that in chat. Keep voting. I guess we can end the poll, right? Because we know. 69% of us perfect, all things in balance, my friend. 69% of us. No cut. Well done. What's that equate to? Almost 1,000 of us. Well done. Just drop the beats. Good or bad? Honestly, it's as expected. Nothing. Here we go. The volatility continues as the dollar now retracing the little bump it had down. Same can be said with Bitcoin. A little bump up on the news, now back down. This is what we talked about at the beginning. Trading today is very difficult, very volatile, very risky. Encourage you to just sit and chill. Sit and chill today. Look at those candles. Bitcoin actually doing very little, I would say. Doing very little. Dollar getting more spicy here. Brazil, sell everything. Go for it, brother. If you're late, you're not late. Mr. Mayo, you're not late, bro. You got 25 minutes. No change is the right decision. That's my opinion. That is my opinion at the moment. But we're going to get the rate change was very unlikely. Very, very unlikely to the point where I was like talking shit to people about it. I was like, yeah, keep dreaming if you think something's going to happen today when it comes to the rate. But there are other very important things that we could learn today when it comes to quantitative tightening, quantitative easing. The dot plot projections of where they see interest rates at the end of this year, into next year, and the year after. Those are very important. While they aren't as instantly gratifying as an interest rate decision today, they are equally important and can have equal weight on the market. They can push the market equally. Say quantitative tightening. A look into if they're still looking at 2 cuts this year. Changing the amount of cuts from 2 to 1 or 2 to 3 or something. These are big potential things that can still happen. The cut itself, honestly, guys, I'm just gonna let you in on a secret. Come closer. Come in. Come here. I think the cut's gonna come in September. Shh. Don't tell anybody. Some secret alpha. Don't clip that, chat. Don't clip it. Don't tell anyone. It's our secret. Yeah. These are some spicy candles, man. This is a little 5-minute kicker. I like it. I like it. The dollar now down and Bitcoin down. And I'm going to assume stocks, maybe gold's up a little bit. On the nothing burger. Weird. Interesting. Today, while Bitcoin did very little, Coinbase riding the Genius Act, I'm guessing. That's my explanation. The chart was showing a breakout, but riding the Genius Act, perhaps. Coinbase breaking out, busting through May levels. May high at 277, traded almost to 300 today. That is a valid, real breakout here. If you invert this chart, I see nothing but strength. I see nothing but strength in this chart. Well, weakness, but it's inverted, right? Big old scary head and shoulders. Here's the good news. Boom. It's upside down, baby. Probably another neckline sitting here at 300. Coinbase may look to reach its all-time high levels, maybe come back to 300, push higher. Coinbase and Bitcoin. So you're like, oh, well, I don't know. I don't own it. Coinbase doesn't matter. Depends. Coinbase and Bitcoin have been highly correlated. Here's the correlation between, since, I don't know, the IPO. Here's the correlation between coin and Bitcoin. You can see that it has dipped down at times, but in general, they remain highly correlated, spending most of their time not at 1-to-1 correlation, which is like perfect correlation, but up in the 80s, 90s. That is incredibly correlated. Unfortunately, we do see Bitcoin moving down today, and at the moment, obviously, their moves are counter. So that correlation dropping temporarily at least. So is this potentially a good sign for Bitcoin? You know, I'm kind of interested. When was the last point it was low? Up here as it began to fall. That would require more study. I will in general take this as a bullish sign for the crypto space. Coin tends to run. Maybe I should do this actually with total. Nah, it'll be like the same chart. It's not worth it. It's not worth it. Bitcoin looking to put on some gains. I think a nice, potentially leading signal to the rest of the crypto market. If that were kind of in a bubble, I maybe wouldn't give it as much weight, but there's another crypto stock that is riding the Genius Act approval and potentially flagging or signaling for bullishness in the crypto market, and that is going to be the hottest freaking IPO I have ever seen. I own none of this. I'm not shilling it. I'm not telling you to buy it or anything. I don't have any. But this chart, holy shit. I had my doubts when we first saw this move. I will pat myself on the back here because I know there is a clip or two out there where I said 103 to 125 would be a strong trade. That slapped. But I certainly did not expect to see coin trading all the way up, or not coin, Circle trading all the way up to 181, I think actually 185 today. Huge gain on this IPO, 22% today. If this isn't a bullish signal for the rest of crypto, I don't know. I don't know what it is. Putting this into context, Circle is a stablecoin. Stablecoins are extremely profitable, and they IPO'd, 2 weeks before this legislation was passed? Kind of feels insider tradey, doesn't it? A little bit? A little bit? Maybe a little bit. I don't know. Either way, miraculous timing. Anybody who got in on this, holy shit, killing it. Killing it. VZ Fat Cat, brother, I asked you not to joke about killing people. You joked about killing people. I'm sorry if you have a problem with that, man. We need a rate cut, Mikey. I don't know what to tell you. I'm just telling you my opinion. Guys, you don't have to agree with me. That's what makes the world wonderful. You don't have to agree with me. So here's the stick in the mud, though. MicroStrategy. MicroStrategy, I would have kind of expected to be up with these other stocks. Not so much. Still very bullish. Still holding on to his gains. Still near its highs. But I kind of would have expected this to be trading a little higher here with those others. I think an important note. Markets are closed tomorrow. It's a national federal holiday. So maybe they're, I don't know, getting in their moves for tomorrow, something like that. Coinbase applied with the SEC to offer tokenized equities. True. True, they did. Tokenized equities. I saw that. I haven't had time to look into it. I don't really get it. It'd be so important. But it is what it is. What's up, Crypto Carnage? Brandon Keys. You must agree or else. Yeah, that's the thing. It's cut day? It's cut day. It's not cut day. Not yet. September. Where's my tank? Sure, I was wearing it earlier today. Man, this has been a slower price action than I'd say the previous few, which also were nothing burgers in this sense. But man, Bitcoin after the interest rate decision, now sideways, not even like moving. The dollar down, but I feel like they're waiting for Powell to speak. Gave me a thumbs down. That's okay, brother. The banhammer rain. No rate cuts is already baked in. Yeah. Yeah, but at the same time, no rate cuts was already baked in the previous FOMCs, and we've seen bigger price action changes. So I don't know. Maybe attention is just elsewhere today. Circle, coin, dollar falling. I don't know. Take a look at Crow. We got 20 minutes. Maybe we can. See you in September. That's right, Rokas. I think in September we get our cut. What's good, guys? Let's get to 1K likes. How are we not at 1,000 likes yet? You're baked in. That's right. I'll be baked in later. Giggity goo. And I'll pull up Crow. Screw it. Screw it. I don't have anything else I want to talk about. How much did I pay for this thumbnail up here? Nothing. Oh, actually, you know what? That's not true. That's not true. Before Crypto made this for me a while ago. I did pay him for some amount of thumbnails, so you're right. I don't know, though. I don't remember. You're baked. Crow. Why am I looking at Crow? Crow's not doing anything yet. It's not moving. Why are we looking at Crow? You put it on the months and, man, kind of weird. Insider shenanigans, perhaps. Perhaps. I don't have anything really to say about Crow, to be honest. Break 11.6 cents, and then there's something to talk about. If you test 7 cents again, that's looking bad. What's up, Tusk Reaper? Good to see you, bro. Toyota Crown. I would love a Toyota hybrid, actually. Everyone waiting till September. I don't know. Well, I don't know, man. People have thought every single month that this was going to happen. I'd say we're getting closer. I'd say I would say we're getting closer. Soul. Arrow trade was fire. Somebody commented on this stream. It's the stream that we did this. Said thanks for charting Arrow. Who caught this trade? It's a good one. Look into my eyes. One day, that's right. One day. One day. Remember, rates did already come down once. They did already come down from their highs. Solana, back to the entry. You don't like to see it back at the entry again. Once, you love it. You love it at your entry once. Twice, maybe you can double dip, right? Maybe you're like, I get a second chance. 3 times, not a comfortable feeling. Not a comfortable feeling. Solana, man. Solana's just not quite there for me yet. Where'd he go? There it is. Put simply, I still believe Solana is going to test its 200-day. I just don't love this. We have tested 143 as support 3 times in the day. These are probably weekly tests too. This is the 100-day moving average. Each time you test it, it's getting weaker. Support there is being eroded. The 200-day is coming down quicker. I don't love it. I don't love it. Don't love it. Remember, we talked about taking profit early on this long when it hit the first time, maybe at the 50-day moving average. That seems to be playing out. You just can't like this lower high retest. Like this is doing this now, my friends. Could prove me wrong. We could escape this. But for the moment, we have not. Flat bottom. Highs coming down, flat bottom. That's not good. It's not a bullish take. I don't see it yet. If you look at the BTC pair, really also not showing strength that you'd like to see. If this was showing a little bit more strength, maybe I could be a little more confident in 143 holding. But I think Solana versus Bitcoin has a little bit more downside. Makes sense when you look at Bitcoin dominance. You tie it all together. Dominance clearly not done, in my opinion. I've been saying this forever. Clearly not done. Looking for higher highs. Pain these tiny little green weeks. You're going to buy some SOL below that support on some bad news in the Middle East? You know what? No! Let's look at that. Where might that be? $100. You already tested 100. Here's my gripe here with Solana. 100 could be a really great buying opportunity. And even, you think of it this way, right? You sold off to 100. If you bounce at 100, there'll be a higher low. You could put in a bottom look to move up. But you lose 100, and on the month, what do you have? Almost nothing. You have very, very thin support below you, under 100. No doubt that 100 is likely a strong support. It has been tested once, so it's had a little bit of its glory, a little bit of its strength eaten away. But it's a nice psychological number. I think you get a bounce if you trade there again. But if you lose it, man, what do you got below you? Very little. Very little. I don't think we're trading down here this year. Let's put it that way. I don't think that we're coming down here. I think that maybe in the bear market, let's say like next year, maybe you see this. I think that this was the low for Sol until the high is in, whatever that is. I think the USD low is in. I just don't think the Bitcoin low is in. That's where I'm at. Man, this is like the least volatile. This is crazy. This is actually crazy. We have covered dozens of FOMCs, and I think this is the least volatile, the least swing that we have seen. Maybe it's coming when he speaks. This might be in the bottom 5% of volatilities on EMA, or on EMA, on FOMCs. Max says there's a difference between MA and EMA. There is. I have a video on it in the free playlist on this channel. You can check out that and many other topics. We'll have let's do this. I'm going to do a poll. Publishing. I have a few of them. I'll let you vote. Bollinger Bands. Relative strength. All right, I'll let you vote. Whatever wins, we'll publish that one. I have a free playlist. You can check it out on the channel, but I have one about MAs. So they are different. EMAs and MAs are the same thing, but their calculation is different. Basically, EMAs, now let's start with MAs. Basically, moving averages are just, let's say your moving average is set to 10. You're just looking back at the last 10 candles, and you're saying, okay, what was the closing price of those 10? Then you're adding them all up, dividing them by 10. You're just getting an average. And then when a new candle paints, it drops off the last data, continues. An EMA does the same thing, but the calculation weights the candles by proximity to the current candle. So what that means is candles that are farther away are weighted less, and candles closer to price are weighted more. And so what you see is basically a faster reacting moving average. That's their difference. Faster reacting sounds good, but it doesn't necessarily mean better. And I'm not even going to argue that either is better. Comes down to preference. Both can be used successfully, in my opinion. All right, there we go. The dual mandate. I can't believe how little spice there is right now. Seems fitting. It's like just a weird freaking week for crypto. Thanks, Legend, using most of the EMA. Most people do, man. I use moving averages, just MAs. Most people, I would say, use EMAs. I think you can use either. Whatever works for you. Which is more popular? Probably EMA. I would say probably EMA. Who's the new GF? Greena. Hopefully Greena's there. She hasn't been there either. What's up, KDP? How you doing, man? Knowledge. Thank you, sir. We need some big words for movement. Supercalifragilisticexpialidocious. There we are. 10 minutes until Chairman Powell speaks. Just 10. Mr. TC, can't wait to see the candle once Powell starts babbling. You're right. I think no news is going to turn into good news. That'd be good. We could use some good news in the world, bros. We could use some good news. There has been some not great news over the last week. Let's turn that around. Let's turn that around. We need some good. Let's put good energy out there. What good things? Anybody have any good news? Anybody? Put out some good news. We need something good. Low volatility is bullish. All right. Crazy times, Nirvana? Could be. I can't believe how slow this is. Did they change anything on the balance sheet? We'll find out. We don't get that until Powell speaks, Arrow. Volk says crypto's not dead. He just doesn't think that we see 4-year cycles anymore. I mean, that's becoming a pretty popular belief. That's becoming a popular belief, I would say. You know, I might even be dabbling in the belief, but an issue with that is people are starting to kind of accept that, but we haven't seen a deviation really from the 4-year cycle yet. If this year comes and goes, and for instance, we don't see another all-time high this year, but then we don't start into like a bear market next year, meaning, I don't know, we don't see like a 50% reduction in price next year, then I think you can reasonably say the 4-year cycle is either dead or it's skipped or delayed or something, right? At this point, we're just largely on track still, though. Like at this point, we're just exactly where we should, you know, I say should be. What does that mean? But we're just on course. This would look exactly like every other cycle if we do nothing this summer. It just goes sideways this summer, and then Q4 we see an all-time high, tops in, cycles over, start over again. Then it would just be exactly like every other cycle. It's just a little too soon to call it. I do understand that there are different elements at play in this cycle, specifically starting in 2024. Only compounded into 2025 with Donald Trump and being president and a complete different stance on crypto. Genius Act just freaking passed. Crazy. I understand that, but it's just too early. It doesn't make sense to me to call it yet, but it'll be very easy to know, basically. You have trouble? I don't know. What do you mean, Bob? What's up, Joe Fulcher? Do I like ICP? Not really. Do you mean insane clown posse? Maybe. Dankin and Crypto Dead, another 4 years. This is weird. Not gonna lie. This is weird. It's weird. We've always seen more price action. Only 241 votes. Not as exciting. I guess we only have 5 minutes on it. RSI or Bollinger Bands? I'm going to publish another lesson on Friday to the free trading playlist. If you don't care, just, I don't know, just throw a vote up there. It's all good. 5 minutes until Chirpow joins us. I'm going to refresh this. Oh, Gina. Come back to us, Gina. If only. Hold up. All right. By the way, guys, keep smashing the likes, subscribes. Keep it coming. I know this is like a chillin' vibe today. It's different. Maybe we're getting the spice. Maybe it'll be when he speaks. I don't know. These are really small candles for an FOMC. Who makes these sunglasses? I don't actually have a manufacturer for them anymore. These were by Wear Me Pro, but I don't think they make them anymore. Not gonna do the recap of last meeting. Nostalgic, we did that last time. I should have done that. We don't have enough time now. I don't think we have enough time. Oh yeah, we do. We have literally just that amount. This is gonna confuse a lot of people. But let's do it.
My colleagues and I remain
focused. Why? This is uploaded by them and it's in stereo, but it's only in one speaker. This is gonna drive me nuts.
On achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Oh, it won't be for you guys.
Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are...
All right, that was... I thought we had enough time to do it. That was last month's. This is live now. This is real. This is it.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level.
Short-lived?
It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
Womp womp.
In our SEP,
Here it is.
FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the
Almost
federal funds
all of
rate
them
will be
see one cut.
3.9% at the end of this year the same as projected in March.
Two-cut.
The median projection
Two-cut.
declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy, strategy, and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
So two cuts this year. 2 cuts. No QE
Thank you.
yet.
Colby Smith with the New York Times.
And a QT
To
yet.
what extent has the more limited impact
Gina.
from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So
2.
we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there. You've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
But you say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates
Gina.
more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing,
That wasn't a
concentrated
question.
in just a few industries. We've seen some housing data, including this morning, that has been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place.
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. And if you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer, and each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict, and we haven't been through a situation like this, and I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick.
No Gina, no cuts. What is
The Wall
this?
Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more
No
the divergence we
volatility
see in the dot plot, particularly around the 2025 rate projections.
This could be good.
I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that
Great question, actually.
play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
The dollar likes this.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in the short term?
With what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on.
Of course they wouldn't.
But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we
Brad
see
just nailed it.
are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay,
Brad
thanks.
nailed it.
The other thing I wanted to follow up on is if you If you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly
Chair
O'Grady,
Powell,
CBS
drink
News.
it.
You're famously known as the guy that makes decision based on data instead of speculation. You
It's
said
Greena.
today the inflation data is in a good
There she
place.
is.
We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well,
Sexy and intelligent.
The forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that the tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
Fair.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans.
dumping.
When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokway with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the
Chair
Financial
Powell.
Times.
I
As you're
love
no
her
doubt
voice.
aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs, and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back, and from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps. It not just doesn't help the Fed. It helps the government. It helps Congress. It helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy, and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Who knows? Circle is just going. I don't know.
Thank you. Chair Powell, Matt Egan from CNN.
Chair Powell.
Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation, and what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that.
And Chair Powell, would you use the large language model
for some time?
It's a good question, though. There have been some good questions.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell.
Chair Powell.
There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movements of the dollar was impacting the economy. Are we going through something like that now? That, you know, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. You know, from a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, but and it doesn't change our objectives or what we need to do. And you know, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. You know, will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. You know, AI could cut in the very other direction. AI could make people much more productive and
that's gonna make us all
push
stupid.
in the other direction. I don't know though. So
gonna
but
make everybody
you're right.
stupid.
But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack really. I mean, at the margin, remember you're at 4.2% unemployment. That was for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, you know, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, you know, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You know, you're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but you know, those are good numbers. So it's a pretty good labor market. The thing is, there's
pretty good.
A more
Pretty
concerning
good
thing
labor.
is
Pretty
there's
good.
not a lot of layoffs,
Pretty
but there are
good.
not a lot of job creation. The number, if you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very carefully.
Did he just
because
say
if there
very
were to
few
be,
people are being laid off?
You know, significant layoffs, and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years.
Literally all my
And,
friends have
it's
gotten
been
laid off
remarkable
in
to
the
see
last
just
year.
again and again
Right,
when
real
people
life
think it's going to
peoples.
weaken. Now, eventually it will, but we don't see signs of that now.
Pretty good. Yeah, what? All my friends have been laid off in real life. All of them.
Hi, Chair Powell. Jean
Very few
Young
people
with
getting
M&I
laid.
Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, you know, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, it's think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case, at all. It's not something people are writing down, but in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
You're welcome very much. That was the least volatile FOMC ever. It was the most important, biggest, craziest one until the next one. But it was, wow. Talk about no volatility. That is a crazy miss. The dollar made some modest gains. Circle IPO going absolutely bonkers. I actually made a call on that earlier. But earlier, going bonkers. Going to the moon, I guess. It's at all-time high. It's already hit the measure move targets. I'm not really sure even where to look next. Markets are closed tomorrow. So maybe wherever it closes today will be its local top for now. Coinbase making some good gains. Bitcoin just doing nothing. Doing nothing. I appreciate everybody tuning in today. I don't know. Usually they're just so crazy that there's so much to say at the end. 2 rate cuts. That's the big takeaway. 2 rate cuts in this year. We're in June. We only have so many more months left. The dot plot showed an average of 3.9 as the interest rate by the end of the year. That is 50 BPS or 225 cuts. Probably come in September. September, October, I don't know. We'll find out, but we'll be covering them. I appreciate you guys for tuning in. Make sure you jump in the Discord, discord.gg/TomCrown. Make sure you have subscribed. We are live here Monday, Wednesday, and Friday doing trading and analysis, covering charts and all the goodies. Make sure you tune in. Make sure you tune in. You can check out our free trading playlist on this channel. New video coming out Friday. It's going to be RSI. You guys voted for RSI. RSI it is. Man, not a lot else. I'll catch you guys soon. Chirpow.